Hey, hi everyone. So welcome to another video. And today we are going to discuss about the Blackstone, which is the largest firm in the world of private equity as well as real estate in USA. So what we are going to discuss today is the important details about Blackstone company, its CEO, and especially how it made profits and what challenges it has faced and how it became profitable. So this is what we are going to discuss today. Okay, so Blackstone was founded by Stephen S. Quazman and Peter J. Peterson. Stephen S. Quazman was a Harvard Business School MBA guy, and he worked in Lehman Brothers and rose up the ranks. And he was a managing director, and he was in good terms with Peter J. Peterson, who was the CEO of Lehman Brothers. They both left and formed this private equity firm called as Blackstone, which is headquartered in New York City, and it's an alternative asset management firm. It specializes in private equity, real estate, and even it has hedge fund solutions also. Okay, and its ticker on the New York Stock Exchange is BX basically, and the assets under management are over 1 trillion as of 2024, and it's the largest alternative asset management in the manager in the world. Core business segments are private equity, so they basically buy out some profitable companies, and they infuse some capital into it, and then make them better performing, and they sell it out to buyers after making it more lucrative business and profitable business. Growth equity, they also invest in growth of a particular company, and yeah, and then make money when the company grows. Restructuring they do, and some companies they do restructuring and turnaround of the businesses, and they make money from that also. Real estate, large real estate portfolios are there, and real estate investment trusts are there under Blackstone. So Blackstone manages these real estate portfolios and REITs other than private equity. Example, the real estate portfolios they have is in logistics, hotels, and housing. Credit and insurance also they do direct lending, they do credit funds, and they also do insurance assets. Hedge fund solutions, they have a fund of funds, and proprietary strategies are used in this fund of funds. CEO is Stephen A. Squazman. We had an entire separate video on this, and he's the founder, co-founder, chairman, and CEO. And he's was a former managing director at Lehman Brothers, and his net worth is 30 billion as of 2024. He's known for applying aggressive and scalable models in private equity as well as real estate. So this is aggressive and scalable models in private equity and real estate. Leadership style is long-term strategic thinking and emphasis on fundraising, scale, and opportunistic buying during downturns. Okay, how Blackstone makes money. Management fees they charge, as a private equity firm, they charge a percentage of assets under management, which is typically 1 to 2%. And performance fees also they charge, which is carried interest to 20% of profits made for investors above a hurdle rate. And this is a real money maker where deals go well actually. Okay, investment income, Blackstone invests in its own funds, earning returns from its own capital. So they do invest some of their capital also, and earn money. So they do investment also other than charging management fees and performance fees. Insurance float, acquiring new insurance firms like Allstate, Life, FNG to use their float for investments. So these are the different ways the company makes money. How it went to profitability and growth, Blackstone, when it formed, it had a lot of sales calls where uh, Stephen Squazman used to go to different companies and pitch this private equity idea and fund management idea. And yes, he got one big client, and from that, all the clients have flowed in, and it became a biggest private equity firm in entire US, managing real estate portfolio and private equity firms all across the globe, also not only in US. So key strategies is buy low, operate better, and sell high. So basically, they buy undervalued businesses or real estate, okay, and they put money into it. They improve the operations of it, and they restructure that company, and they sell it at higher valuations. Okay, so this is the basic business model. So you buy a company at a lower price, you infuse some capital, make it better, you improve it operations or restructure it, and then you sell it at higher valuations to opportunistic buyers. That's the first strategy. Scale and brand, build a reputation that attracts institutional capital. So once you are at a certain stage and are generating very good return, so then you will definitely have a good reputation in the industry, and you will attract more and more investors, like institutional capital, like pension funds, sovereign wealth funds, etc. So this is also a strategy where they use their brand name and scale at which they are operating to generate attract more capital. They're able to raise massive funds quickly, around 26 billion for a PE fund in 2023. They are able to raise diversification. So not only private equity they are doing right now, they have moved beyond private equity into real estate, credit, insurance, and infrastructure. They reduce reliance on economic cycles in any one asset class. Okay, crisis opportunism. So this is their speciality. So they profited from buying distressed assets after 2008 and also COVID-19 and during market dislocations. So they are very good at buying distressed assets. And example is, acquired a large portfolio of foreclosed homes post 2008. Okay, so buying it a very very cheaper rate when the assets are very distressed assets, and then once putting some capital into it, or then once the market goes up, you sell it at a higher premium. So that is crisis opportunism. So these are the four strategies: buying low, operating better, and selling high, scaling and branding, diversification, and crisis opportunism, by which the firm has grown to profitability and growth. Challenges also the firm has faced during the 2008 financial crisis. They had a lot of exposure to real estate and credit markets, and their portfolios were marked down. So there were a huge significant markdown in their portfolio values, and they were not able to exit. Also, delayed exits were there due to frozen markets. Okay, so what they did in this time is, the response they handled this particular financial crisis is they raised capital from opportunistic funds, right? So whoever has a view of growth in the future during that crisis time, they were able to raise capital from those funds and invest to go through that financial crisis. And with those funds, and even with their funds, they basically were able to acquire distressed assets also cheaply during that time. And uh, and they were able to pivot whatever portfolios they have of real estate into rental real estate, invitation homes. So they just basically bought a lot of real estate and at a very cheaper price, and they were renting it, calling invitation homes, and were able to raise capital from opportunistic funds at that time, which is a great thing. This is a very fantastic, challenge, or a crisis management response. Reputational criticism, they also had another challenge, that they were being viewed as a Wall Street greed in many political narratives, and they were criticized for buying all the single family homes and raising the rent in that areas, or in wherever they bought that houses. Their influence on housing prices was being criticized for, and job cuts also. Whenever they do a private equity, their one way of improving operations or turnaround is, some jobs will be cut, and job cuts, for that they also received criticism. The way they are tackle this is through PR campaigns highlighting long-term growth in the portfolio firms they are managing, and also focusing on environmental, social, and governance criteria. They also face real estate headwinds in 2022-24. So interest rate hikes have hurt their commercial real estate values, and Blackstone's real estate income trust faced redemptions. Redemptions is customers taking their money back basically from the fund. Okay, so what the response they have done is they imposed the gates limits on withdrawals, and they rebalance the portfolio towards more logistics and rental housing with better fundamentals. Okay, and still they were able to deliver a strong long-term returns. Okay, so even though interest rate hikes happened, which hurt the real estate values, they and customers were taking money of basically redemptions were happening. They imposed gates limits on withdrawals, and they rebalanced their portfolios and focused more on logistics and rental housing. That's they were able to navigate through this real estate headwind. So the response to challenges is very good if you see overall. You know able to raise capital from opportunistic funds when financial crisis was there, and a PR campaign highlighting long-term employment growth in portfolio firms, and this having going for logistics and rental housing with better fundamentals. These are very good responses. They also have regulatory scrutiny. Complex fee structures have drawn SEC interest, and new regulations around private fund transparency and investor protections. The main thing that made them successful is their visionary leadership by Squazman and his fundraising power. He has unparalleled access to institutional capital. This is their main strength, if we have to say. Crisis agility, this is also a main strength. They are able to excel even during crises, and they were able to buy when other people are panicking, and buy the distressed assets. Disciplined investment process, strong risk controls and due diligence they have, and global reach they have. They have offices which deal across continents. So this is about Blackstone, guys, the largest private equity firm, and the largest real estate portfolio management firm in USA, and yeah, the challenges they have faced, and why, how they make money, and how they go to profitability and growth. Thanks everyone for joining the call. Have a nice day. So, hi everyone. So, we'll also discuss about private equity strategy, which is used by Blackstone, and the core mechanics in that private equity strategy, how the deal structure happens in private equity. So, let's discuss that also. So, private equity firms like Blackstone use leverage debt. Okay, so and investor capital. So, large institutional investor capital they use, and their leverage debt also they take to buy companies. A simplified structure is, equity investors 30% capital they take, and debt loans 70% they use. And this is called as leverage buyout. Okay, so leverage buyout they do of the companies, and once they do a leverage buyout, what they do with that company is to make it profitable is they do operational improvements, basically cut costs where unnecessary costs are there, they'll cut it, and they'll increase the earning before income and taxation, tax depreciation. Okay, and multiple expansions also they'll do. Okay, profit sources, operational improvement is one profit source. So if you cut down costs, and revenue stays same or improves also, you'll make a lot of money because you cut down the costs, right? Multiple expansions, so they buy at 6 into EBITDA, sell at 9x. Okay, so they basically buy at whatever earning before income tax and depreciation you have, 6 times of that, and they sell it 9 times of that. Debt pay down, use company cash flows, they use this company cash flows to reduce the leverage. So this is their main deal structure. Carried interest, basically they have fund managers like Blackstone get a share of 20% of the profits after a hurdle rate, often 8%. Okay, so if you cross 8% returns, then you will get 20% of that profit. Okay, so this aligns manager incentives with investor success. So this is a deal structure in private equity firms like Blackstone. So I just wanted to cover that also. Thanks everyone for joining the call. Have a nice day. Bye.